This is Alan Bush with ADMIS. In the stock index futures, yesterday we did see some pretty good gains, even though the retail sales number did come in weaker than expected. However, today we are seeing a little pressure developing early. This with the consumer price index coming in up 0.5% against the guess of up 0.3%, so that a bit bearish. However, overall, it looks like futures are again performing relatively well versus the news. Of course, then we did see some strengths coming back in this after the housing market index coming in quite a bit better than anticipated. So overall, futures responding well to the news, even at these very lofty levels. Of course, we do have Bernanke speaking tomorrow morning. This is his semi-annual testimony to Congress, so there could be some clues as far as what the Fed is thinking in their quantitative easing program. Over in the currencies, now that the Fed has, so to speak, reinstated their unlimited quantitative easing program, the dollar has gotten weaker over the last several days. Some pressure again today in the dollar index. We are seeing some gains in the euro currency. We did have the German economic numbers coming in a little bit better than expected in some respects as far as their trade numbers. The Australian dollar trading quite a bit higher. This after the minutes of the most recent Reserve Bank of Australia policy meeting, suggesting that the central bank will not be lowering interest rates anytime soon. So from an interest rate differential point of view, the Australian dollar gaining. However, we do believe that ultimately we will see Australia's central bank cutting rates, and of course that would be bearish for the Australian dollar, not to mention the weakening Chinese economy, which is an ongoing negative for the Aussie dollar. So even though we are higher here in the Australian dollar, I think that most of these gains will be given back today. It was just last week that we did see three-year lows in the Australian dollar, and I think that over the next couple of weeks we will see these lows penetrated again on the downside. And in the credit markets, recent gains linked to the on again, off again now on quantitative easing program, as stated by Bernanke in some of his comments from last week. We feel, though, that these gains are probably a bit overdone now as we move now to the resistance area in the September Treasury bonds at the 135.5 level. So that is good chart resistance. So from here, I would look for lower prices. Ultimately, I think we will see the downtrend resuming, and I do believe that the main trend is still bearish for the Treasury futures market. Once again, these are my opinions alone and are not the opinions of ADMIS or Archer Daniels Midland.